What if I told you that in 2026, thousands of Americans who thought home ownership was impossible are suddenly getting approved for mortgages with lower credit scores? For years, many buyers believed you needed near-perfect credit, a huge down payment, and zero debt just to have a chance at buying a home. But the mortgage game is changing fast. New credit scoring rules are reshaping how lenders evaluate borrowers, and for many people, this could be the biggest opportunity in years to finally buy a house. If your credit score has ever held you back, or if you thought renting forever was your only option, stay with me, because these new changes could work in your favor. For decades, mortgage lenders heavily relied on older FICO scoring models that often painted an incomplete picture of a borrower's finances. Those systems focused mainly on traditional debt, like credit cards, auto loans, and missed payments. But in 2026, more lenders are transitioning toward newer scoring models that can analyze a broader and more updated view of your financial behavior. That means lenders may now consider factors that older systems ignored, such as improved payment habits, reduced balances, and in some cases, alternative credit data. This doesn't mean credit scores no longer matter. It means the rules for how lenders judge risk are becoming more modern. So what does this mean for someone with lower credit? It means a borrower with a 620 score today may look more attractive than a borrower with the same score did just a few years ago. Why? Because newer models can better recognize momentum. If you had credit problems in the past but have spent the last 12 months paying bills on time, lowering debt, and managing your finances responsibly, that progress may carry more weight. Lenders are beginning to understand that people can recover financially, and many want to capture more first-time buyers entering the market. One of the biggest mistakes people make is assuming they need a 760 score to buy a home. In reality, many mortgage programs already allow lower scores. FHA loans have historically been more flexible. VA loans can offer strong options for eligible veterans and service members, and certain conventional programs now compete more aggressively for qualified buyers. In 2026, the key difference is that lenders are using newer tools to separate risky borrowers from borrowers who simply had a rough patch. That distinction matters. Someone with stable income, manageable debt, and improving credit may now qualify faster than expected. Debt-to-income ratio is also becoming a bigger conversation. Your credit score is important, but lenders still want to know whether your monthly income can realistically support a mortgage payment. If you make $6,000 a month but already owe large payments on car loans, personal loans, and credit cards, approval becomes harder. But if you lower those monthly obligations before applying, your chances improve dramatically. This is why smart buyers in 2026 are focusing not only on their FICO score, but also on eliminating unnecessary monthly debt. Sometimes paying off a $300 credit card payment can do more for mortgage approval than chasing a few extra score points. Another major shift is how rent history and cash flow are gaining attention. Many Americans have paid rent on time for years, yet older mortgage systems gave little credit for that responsibility. Newer underwriting approaches are more open to reviewing bank statements, consistent deposits, and payment patterns. If you've been paying $2,000 in rent every month without missing payments, lenders increasingly recognize that as proof you can manage housing costs. That could be game-changing for renters who felt trapped by traditional credit standards. If you're trying to buy a house with lower credit in 2026, timing matters more than ever. Applying before cleaning up your profile can cost you thousands through higher rates or denial, but spending even 60 to 90 days improving key metrics can create a completely different outcome. Paying balances below 30% utilization, disputing reporting errors, avoiding new hard inquiries, and keeping every payment current can move your file into a stronger category quickly. In the mortgage world, small changes often create big results. Interest rates are another reason this conversation matters. Even if rates fluctuate, your credit profile directly affects what rate lenders offer you. Two buyers can purchase the same house with the same income in the same neighborhood, yet one may pay hundreds more each month, simply because of weaker credit preparation. That's why smarter buyers aren't just asking, "Can I get approved?" They're asking, "How can I qualify on the best possible terms?" That mindset can save tens of thousands over the life of a 30-year mortgage. There's also a psychological shift happening across America. Many renters delayed buying because they believed home ownership was reserved.
Please subscribe to my YouTube channel